Good morning. Welcome to Stock Market Today and happy Friday. It's Friday, February 8th, 2019. I am your host, Dan Russo, the Chief Market Strategist at Chaikin Analytics. You can follow me on Twitter. I'm at Dan Russo _CMT. Stock Market Today is brought to you today and every day by Chaikin Analytics. And if you head over to chaikinanalytics.com/today, you can sign up for a free email. You'll be able to follow along with this show, as well as receive daily stock ideas to consider, all hitting your inbox every morning before the market opens. So let's dive right in now. U.S. equities were lower in Thursday's trading, which saw the NASDAQ underperform. Energy was the biggest decliner at the sector level due to weakness in crude. Tech, materials, and healthcare also trailed. Defensive sectors outperformed on the day. Treasuries were stronger across the curve. The dollar was slightly stronger against the euro, but weaker against the yen. Gold, pretty flat. WTI crude settled down 2.5%, though it did close off the worst levels of the day. As we get to the desk this morning, S&P futures are down 60 basis points after finishing lower for a second straight day yesterday. Asian markets were lower overnight, with Japan down 2%. China does remain closed for a holiday. European markets are mostly weaker this morning, though the weakness is fairly limited. Treasuries are mostly unchanged, and the dollar is flat on the major crosses. Gold up 10 basis points. WTI crude is off another 20 basis points. And as we look at the S&P 500, we'll say that the 200-day moving average passes its first test, right? Test, acts as resistance, market trades lower. Support now in the 2650 to 2680 zone. We did come pretty close to testing that top end of that zone yesterday, but to me, the key level is down around 2600. We want to see the S&P 500 hold this 2600 level to give us confidence that this is a viable pullback and that, we are in fact going to begin to move higher. Resistance is at the 200-day moving average. Should we break through the 200-day moving average, then we're looking at these interim highs here around 2815 before starting to think about the all-time highs from back in September. It's interesting to me, I've commented on this before, is that the RSI never reached overbought. Strong rally off the lows here, swift and strong, V-shaped type rally off the lows. I would have been encouraged if the RSI actually became overbought to give me a signal or confirmation that momentum was strong with the trend. Now, the RSI, after failing to hit an overbought level, is beginning to turn lower. That, to me, tells me that this upside momentum is waning. Now, Chaikin money flow is bullish, but beginning to turn down ever so slightly. So the key area right now, as far as I'm concerned, is the 200-day moving average. We want to look for support levels to hold. In the near term, 2650-80. Bigger picture, 2600. So as you're thinking about getting involved in the market and looking for bullish ideas, you want to see the key support areas hold, and then you want to look for bullish and very bullish stocks when they become oversold. So what are we talking about in the note today? Chaikin Analytics client stock closed lower for a second consecutive day. We hit on that. 200-day moving average provides resistance for now. We hit on that. Retail stocks underperformed during the rally from December, and I think that that's interesting. We'll take a look at, we'll dig deeper on that. Relative strength in semiconductors is a bright spot, and it's for me, one of the key relationships that I'm looking at. To me, if semis continue to outperform as they have been, that greatly lowers the probability that we're going to test those December lows. To me, it increases the chance that key support levels, especially around 2600, should we get down there, are likely to hold if semis are continuing to outperform as they have been. It's a key tell for me. We're playing a game of, kind of adjusting our thoughts and our probabilities as new information rolls in. So to me, semi outperformance is important. Futures do point to a lower open here today. So for the major indices, all closed lower on the day. Dow down 80 basis points, 3 bulls to 7 bears. S&P 500 down almost 1%, 113 bulls, 93 bears. NASDAQ was your underperformer, 25 bullish or very bullish stocks, 15 bearish or very bearish stocks. Small caps also down, though they did outperform the S&P 500, 431 bulls, 376 bears. Nice day for bonds. Obviously, that helped utilities, which were up 1.3% in a defensive, catching a defensive bid on the day. 11 bullish or very bullish stocks, zero bearish or very bearish stocks. You know we've been bullish on utilities. We continue to be bullish on utilities from a trend perspective, as well as based on our research. You can see 11 bulls, 0 bears. According to the Chaikin Power Bar, small cap stocks and large cap stocks remain somewhat bullish. Major indexes are mixed. Stock of the day today is one that I've liked for a while, but we are not going to chase it here. We'll run through the analysis of why, but we're not chasing VMware here. First off, we like outperforming stocks, and we like them in strong industry groups, and VMware checks both of those boxes. Stock did close down 46 basis points yesterday, but the power gauge rating is very bullish due to very strong price volume activity, attractive financial metrics, and strong earnings performance. Now, very bullish stock, strong trend, strong industry group, fishing in the right pond. Strategically, we know that this is the type of name we want to own. And we can see the market and model are in agreement. Stock's been outperforming since November, and we're on that bullish rating since late December, early January. Now, but the stock is overbought, so we don't want to get involved here and now. Money flow is bullish. That's encouraging. Steady uptrend above a rising long-term trend line, breaking to 52-week highs. About a week ago, this was my bullish stock of the day for Chaikin Analytics clients. That trend is working, but we're not going to chase it here. We're not going to chase overbought stocks with the S&P 500 bumping its head on the 200-day moving average with momentum beginning to roll over. We're going to keep an eye on VMware, though, and we're going to watch how it acts as it either goes sideways or tests key support levels, and when it becomes oversold, we'll revisit that thesis. Sector tracker now, looking at the movement of the major sectors over the last 5 days. You can see that tech has had a strong last 5 days, as have industrials. Utilities and REITs in the top 4. There's your defensives, along with staples. Now, I'm not a huge fan of staples at this stage of the cycle, but I am a believer that rates are likely going to continue to head lower. I think the path of least resistance for rates is lower. That should help your utilities. That should help your staples. Bottom of the list, comms, discretionary, and materials. You know how I feel about materials. Energy, persistently at the bottom of the list. From a power bar ratio perspective, Fins giving some back after rallying at the onset of earnings season with the bank's earnings reports. Now, we are going to take a look now at the regional banking services group, which over the past 6 months has underperformed the S&P 500 by 10% plus. However, we have a very strong power bar ratio, 50 bulls to 8 bears, gets it a rank of 4 out of 21, has moved up 1 slot over the past week. Now, some of the indicative names there, FNB, very bullish rating. Chemical Financial, very bullish rating. Iberia Bank, very bullish rating. Let's take a look at one of those here today. Very bullish stock, FNB, closed up 2% yesterday. Strong trend, strong industry group. So as I like to say, fishing in the right pond. Relative strength is my one hang up here. And what we want to do is look at the relative strength is obviously greatly improved since the beginning of the year, but it's still kind of middling. Market and model, not quite in agreement. Very bullish stock, inline performer. Stock is oversold with bullish money flow. It's retaken the long-term trend line. We want to maybe give this long-term trend line some time to begin to turn higher. To me, FNB starts to become interesting if it breaks through this 1250 level. I'd rather buy strength with relative outperformance through 1250 than buy the stock here. Keep an eye on FNB, certainly worth having on a bullish watch list, but I think it's a little squishy here for me at the time being, especially in light of what's happening in the market. Let's look at our trending names now. S&P 500, gainers and losers on the day yesterday. HBI up 20% with their earnings announcement. CMG, Chipotle. Fortnite might be digging into a lot of recreational activities, but going to Chipotle doesn't seem to be one of them. Chipotle up 11.3% on the day. SunTrust up 10% as they are merging with BBT. C's earnings sends that stock higher to the tune of nearly 9%. MAS up 6.8% following their earnings announcement. Tapestry, the big loser following their print. They missed expectations. Stock down nearly 15%. Twitter down on earnings, even though they did happen to turn a profit. ADS down following their earnings report to the tune of nearly 10%. SNA down on earnings, and some company-specific news on Biogen in regard to a product with Mylan. sends that stock down 7.34% on the day. Our earnings update now. Yum Brands missed by 57 cents. Twitter beat. Stock trades lower. VeriSign beats by 38 cents. Stock is not really doing much here in the pre. Expedia trading higher in the pre-market after they beat by 25 cents. And Marathon Petroleum beat by 43 cents, but that stock did trade. Not trading in the pre-market, rather. Today's earnings, what are we looking at today? EXC from that utilities group reports before the open is a bullish stock. Cody, neutrally rated stock, is trading higher here in the pre-market. Other names to watch, CBOE and ARNC. And Hasbro is a bearish stock, but they are trading higher in the pre-market. Expectations around the toy companies have become so abysmal that the stocks are reacting positively to their earnings announcement. Now let's talk about retail a little bit. Retail was a relative loser during the rally. Now remember, during the sell-off, one of our key tenets was look for the relative strength. Find the sectors and the stocks and the industry groups that are outperforming, and you're likely to find your next leaders when the market begins to rally. The reverse is also true. As the market's rallying, the sectors to avoid, the groups to avoid, are the ones that are underperforming. That's where you want to look for your bearish and very bearish stocks, maybe something like a Tiffany, that have not held up or rallied as much as the market. Here's XRT, the retail ETF, below the 200-day moving average and starting to hit its head-on resistance at the $45 level. RSI has put in a series of lower highs since last June, and never really, after becoming oversold, never got out of these bearish ranges. So when we think about a group to avoid, you look at consumer discretionary and the group looks okay. Drill down to the industry level where you're going to see the real ebb and flow and what's driving the strength in a particular sector. It's not retail and consumer discretionary. Look at the relative strength in XRT. Since topping out in the summer, it has been a nice, steady decline and continuing to go lower. I wouldn't be surprised to see this area down below here break, as relative performance is in a very pronounced downtrend for the retail industry group. High beta versus low volatility. Now, on Fridays, I look at key relationships within the market to get a sense of risk appetite of investors, to get a sense of if a trend is likely to continue. And what's interesting to me is with the market hitting its head on the 200-day moving average and failing to become overbought, we're starting to see a breakdown in the relationship between high beta stocks and low volatility stocks. Think of high beta stocks as your risk-on type stocks and your low vol as your safety stocks. So, high beta outperformed until the summer and then really began to lag, right? This was investors flying to safety, all right? And then as the market rallied, investors were showing a willingness to gravitate back to high beta, but we've now bumped our head on resistance and we're turning lower. If this trend continues to move down, to me, it would be a bearish sign for the market, as it would point to less risk appetite in the marketplace. The ratio is below the 200-day moving average, and notice that the RSI, despite this rally, never exited bearish ranges. I think this is likely to continue, and then we want to see what happens as the market tests some of those key support levels. If the market S&P 500 gets down to 2,600, and this ratio begins to move higher, that's confirmation that 2,600 is likely to hold. Something else we're looking for, relative strength in semis is a bright spot in the market. SMH relative to SPY here has retaken its 200-day moving average. Now, the 200-day moving average is declining, so we want to see how this plays out. But to me, semis rolled over before the market, and they appear to be bottoming ahead of the market as well. RSI moving higher, trying to get into bullish ranges after a series of higher lows. So again, think of the playbook. As the market tests key support levels, if semis are continuing to outperform on a relative basis, that's bullish and gives you conviction that those support levels are likely to hold. So as you can have higher conviction. If we're testing support levels and this ratio is rolling over, to me, that increases the odds that those support levels are going to break. So I hope you all have a great weekend. I will see you back here on Monday. Good day, everyone.